everybody, and welcome to this April 13 short video on the state of the economy. We keep producing those to inform you about what's happening in the economy. And as usual, I am with our chief economist, Stéphane Marion. Hello, Stéphane.
Good morning, Martin.
So we need to start with a bit of an update on the pandemic and pressure on the healthcare system. Stéphane, where do we stand?
Okay, I have to be the bearer of bad news. We know there are new variants on COVID. They're more contagious, and it's having an impact on the health system. And the number of people that are forced to go to ICU is rising across many provinces. So this is the impact, the negative impact. Fortunately, we haven't seen virus mutation, so just a bit more contagious. We're seeing this, but fortunately, Martin, the vaccination campaign continues in earnest, and we now have 20% of the population that's vaccinated. So I think that there's light at the end of the tunnel, that whatever sectors that were reconfined, just a few this week in a number of provinces, the closures are likely to be temporary with the successful vaccination rollout. I know we're frustrated, but we're at 20%, Martin. It's not bad.
This vaccination campaign started maybe a bit slow in Canada, but we're definitely catching up. And that is actually bringing a lot of investor optimism, Stéphane, in the markets.
Well, so globally, investors are saying, well, we have shutdowns, but the vaccines are there. They're being rolled out, and therefore there's hope that these will be temporary closures. So with government support programs still in place, the perception from investors is that we've got a pretty good gig going for the economy in the second half of the year, and equity markets hit new all-time high early this month. So this is good news.
And is it just multiple expansion, or is there some fundamentals behind this?
Well, at first, Martin, people thought that this was just wishful thinking for equity markets, but the reality is, if you look at the slide, profits have turned the corner, and that's good news. And expectations by next year is that earnings per share globally will be well above the pre-COVID level. Almost 10% above the pre-COVID level. So to me, Martin, that means that there are fundamental factors that support the pickup in earnings, and one of them is clearly the accelerating global economic growth prospects.
And let's talk about that. Despite the closing of parts of the economy, Canada could show a very strong number.
Yeah, so profits are driven by nominal GDP, not just real GDP, right? So nominal GDP is looking quite good for Canada this year. So I know we're disappointed that we might trail the U.S. in terms of growth over the next few weeks, but nonetheless, the reality is the forecast for this year is that for Canada to grow 10% in terms of nominal GDP, Martin will be leading the G7 on that front, and look no further than 2 years ahead, and the IMF expects Canada and the U.S. to really be leading the G7 in terms of nominal GDP growth, and with GDP that could exceed pre-COVID level by up to 15%. So that's good news in terms of the outlook for profits.
Let's talk about something that we've addressed before, which is the impact of all of the programs on the economy, and specifically on the budget in the United States.
Yeah, okay. So helping drive GDP growth further in the years ahead is clearly government support programs. And we know Mr. Biden just a few weeks ago deployed $2 trillion, so $2,000 billion in terms of fiscal stimulus, and he wants to do another $2,000 billion. And the reality now is the new estimates is that the impact on the U.S. deficit will be quite large, and we're talking about a $2.5 trillion impact for 2021. So this is just to say, Martin, that there's more fiscal stimulus coming our way in 2021, and that will put pressure on other asset classes throughout the year.
And the number one question that we receive from you is, we've all learned that deficits equal inflation. So what do you think?
Well, first of all, let's start. The impact of deficits on interest rates. And people are saying interest rates are moving up, so clearly people are fearing a lot of inflation. At this juncture, Martin, if we look at this slide, it is true that interest rates have risen quite substantially in recent weeks. But you know what? They're actually only back to their pre-COVID level. To the extent that GDP will exceed its pre-COVID level this year, it's a bit normal. Now, the reality, so it's not just inflation expectations, but the reality is going forward, as you said, there are question marks about the ability of central banks to contain inflation, given the fact that there's a lot of excess savings that could potentially be deployed in the economy. Households have received money from governments, and excess savings might be around 8% of GDP on both sides of the border. So to the extent that people will become impatient and decide to spend their money at the same time, then you could potentially create more inflation. Our view about inflation, Martin, is we will go maybe up to 3% this year. Will it be sustained in 2022? That's the big question mark for market. At this juncture, I would say inflation will be in around the 2 to 3% range next year.
And where do you see 10 years in the States?
Well, under these circumstances, we're at 1.6, 1.7% right now. I think this will be a slow drift towards 2% by the year end, because central banks are saying that notwithstanding the rebound in GDP, there are still certain segments of the labor markets that need to heal before we hike interest rates. So under these circumstances, rates move higher, but modestly so between now and the year end.
And let's talk to end the segment. The employment market is red hot. And what are your views?
So the reason the U.S. doesn't want to commit to a change in its monetary policy right now, Martin, if you look at the slide, labor market performance is quite different between Canada and the U.S. I know Canada might trail the U.S. in GDP in the next few weeks, but it's not so in terms of employment, particularly if you look at full-time employment, which is the key driver of your resilience, economic resilience. So you can see in Canada, we're less than 1% away from the pre-COVID peak in terms of full-time jobs. In the U.S., it's almost 4% still below the pre-COVID level. So under these circumstances, Martin, you can understand why the U.S. Federal Reserve is saying, you know what, I'm going to keep doing quantitative easing. I'm going to keep rates low. I want more fiscal stimulus to bring employment back to its pre-COVID level. That 4%, Martin, represents maybe 8 million jobs. That's a lot. That's a lot of people from the U.S. perspective.
Excellent. So what you're the most worried about is inflation. And as you can see, we don't think it's that dramatic. So keep sending us your questions, comments, concerns. We appreciate them. And thank you, Stéphane.
Pleasure.
And we will be back in 1 month. Take care.